My name is Spencer Ford, Certified Financial Planner with Conservative Financial Solutions. And if you've been paying attention to our videos and our channel lately, we've been talking a lot about bonds, specifically as it relates to bonds in an interest rate environment that's rising. So interest rates are going up. And today I want to talk to you about a specific solution to bonds moving forward so you can have a level of protection in your portfolio and take advantage of market gains as they begin to happen without just taking that entire bond portion of the portfolio and going straight into equities, because you'd be giving up that level of protection. Everybody needs a safe place to turn to for income, even when the market's going down. And we just want to make sure that we have a place to go to. That way you're not selling things at a loss when the market is in a period of decline. So just to kind of circle back to where we've been starting with things, this is the US Aggregate Bond Index. The Fed has raised rates 1.5% so far this year. So they're floating between 1.5% and 1.75%. The goal is to get to 3.4% by the end of the year. So based on that, we're only about halfway through this thing. And if the bond index is already down 11.43%, and we're only halfway through this thing, it definitely looks like it's going to get worse before it gets better. And if you're in a portfolio where you have a significant portion in bonds, you're going to want to make a change, because this is going to continue to fail you, especially if you're in a bond exchange traded fund or a bond mutual fund. So the way I want to go over this with you is I actually want to go through an illustration. And I'm going to start off by having a conversation about the dot-com bubble and the Great Recession. So in 2000, we began the dot-com bubble. The market declined in 2002. It took 8 years from 2000 to 2007 for your money to be worth the same that it was, only to have the rug cut out from underneath you from 2007. Then your money was finally worth what it was in 2013. And if you look at this, it kind of looks like a W, and that's the illustration that we're going to go over today. So if we pull up our drawing screen here, we're going to map this out. So in 2000, the S&P 500 was at 1,552. That was the peak. And let's say you had $100,000 that you were working with in the market at that period of time. From 2000 to 2002, when the bottom finally dropped all the way out of the market, the S&P 500 at its low point was 768, which is a 50% decline. So your $100,000 is now $50,000. And it took, like we said, 8 long years from here to get all the way back to 2007, when the market finally recovered and the S&P 500 went to 1,565. So finally, in rough numbers, your $100,000 is finally worth $100,000 again, after the market went up 100%, because in order to have $50,000 turn into $100,000, that's a 100% gain. So when the market goes down 50%, you have to be up 100% to get back above water again. And you finally get there in 2007, like I said, only to have the rug pulled out from under your feet once again. And now you're down here in 2009, when the bottom finally dropped all the way out of the market. And now the S&P 500 is sitting at 676, which, if you look at that, that's actually a 57% decline. And now your $100,000 is $43,000. All right. It takes all the way until 2013, the market going up 114%, for your $100,000 to be worth $100,000 again. The market was at 1,569. Okay, so we're just talking rough figures here. You started with $100,000 in 2000, and you have $100,000 in 2013. That's not great. And it's especially not good if you're taking income over that time period, because you certainly don't have $100,000 left over if you were compounding your losses at the time the market was going down. The specific vehicle I want to talk to you about today is something called a fixed indexed annuity. The way that works is you're linked to the market, so you get a certain portion or certain participation to the market, but you have none of the downside risk. So we're going to assume, just for this illustration, a 40% participation rate to the market. So let's see what that looks like. So you started with $100,000. We're not going to change that whatsoever. And from 2000 to 2002, your money did nothing. It just stayed at $100,000. And actually, I take that back right here. So 2002, your money did nothing. So your $100,000. But what happened is you still have $100,000 down here. And when the market began to recover, you started recovering from a higher position. And so you're going to get 40% of this 100% right now. So by the time we get to 2007, you don't have $100,000. You have 40% of that 100% gain. So your $100,000 is $140,000. And the main reason is because you didn't take a part of any of these losses right here. For the normal investor, the rug got pulled out from underneath of them, but you didn't take part in that. So from 2007 to 2009, you still have your $140,000. The market starts going back up again. You're going back up from a higher position. And so now you get half of this increase right here of the $114,000, not half, 40%. And so your $100,000 is now $203,000. So over that time period, you could have been invested in the market and your $100,000 would still be $100,000 in 2013. Or if you were in a fixed indexed annuity, your $100,000 would be roughly $203,000. Now, this isn't to make an argument that you should put all of your money in a fixed indexed annuity. I would not do that. That's not a good idea, because long term, what the expectation is that the market is ultimately going to do better than that type of safe vehicle. The market's ultimately going to do better than a vehicle like a bond. This is just a bond alternative to help get you through this time of rising interest rates and give you participation to the equity market, which is what provides the most opportunity over time. And we're using this all day, every day for families as a bond alternative so that they have a safe place to go to for income when the market's down. So right now, the market's down, but we're just pulling income off of the fixed indexed annuity. So we're not compounding any of the losses that are happening in the market. We're keeping the same number of shares intact. So when the market begins to recover, all those shares are ready to take advantage of the recovery as well. This gives us a safe vehicle to pull money from to create the most secure retirement that we possibly can for the families that we serve. So if this is something you want to sit down and have a conversation about, please give us a call. We're happy to sit down, create a plan for you, and help anybody out in the best way we can. So thank you for watching this video, and we'll see you in the next one.